Today on the show, Africa Development Bank says the U.S.-China trade war and uncertainty over Brexit pose risks to Africa's economic prospect. IMF warns Zimbabwe against pay boost as living standards crash. Plus, OPEC sees bearish oil outlook for rest of 2019 and points to 2020 surplus. Thank you for joining us and welcome to Business Incorporated. I'm Chimeze Obi Iwagu. First, the markets. And it looks like a good start of the week for some of the markets we track here on the program. The Nigerian Stock Index and the JSE Index in South Africa are starting off the week trading positive, with both indices up 0.82% and 1.18% each at intraday. Egypt, however, lagged, trading 0.80% lower. Kenya closed on Friday positive at 1.11%. And markets in the Middle East were mixed at intraday. Saudi Arabia's stock market rose, helped by banking shares and increasing oil prices. Saudi index advanced 0.86%, with most of its banking stocks trading positively. National Commercial Bank rose 2.1% and RG Bank was up 0.9%. Al Qatar's index rose 0.24%, extending gains in the previous session when it ended a three-day losing streak. Qatar National Bank, the Gulf's largest lender, boosted the index most, trading 1.5% higher. In Dubai, however, the index was down 0.22%. Abu Dhabi's index slipped 0.23% as First Abu Dhabi Bank declined 0.3% and Emirates Telecommunications Group lost 0.4%. And European stocks rose in the morning as hopes emerge for stimulus from central banks and fiscal measures from major economies such as China and Germany. Our German finance minister said on Sunday that Germany has the fiscal strength to mitigate any future economic crisis with full force and suggested that Berlin could free up around 50 billion euros of extra spending. Meanwhile, China's central bank unveiled a key interest rate reform on Saturday intended to lower borrowing costs for companies and reinvigorate an economy being negatively impacted by its trade war with the U.S. Well, let's bring in my colleague there in Frankfurt, Conrad Bussen, to tell us more from the European space. Hello, Conrad. A beautiful week to you.
A beautiful start to the week to you too, Jimmy. Hello to everyone in Nigeria.
Thank you. Well, it's going to be a busy political week in Europe as a G7 summit is being prepared in the French resort town of Biarritz. And, of course, Boris Johnson will travel to Berlin and Paris to meet President Macron and Chancellor Merkel. Any reason for the markets to be relaxed or nervous?
Well, of course, ahead of important events like this, the markets have a little bit of a tendency to be nervous, but optimistically nervous, I would say. Of course, the meeting of Boris Johnson with the German Chancellor and also with the French President likely will have a lot to do with the G7 summit. You know, they have to prepare common positions for some of those discussions, for example, in terms of Iran. Remember, Germany, France and Britain still are supporting the deal, the nuclear deal with Iran, while the Americans have withdrawn from this agreement. In terms of Brexit, of course, there's not much to expect from the meetings between Johnson and the European heads of state like Macron or Merkel, because, of course, it's the European Union that negotiates Brexit. And Juncker and the negotiators for the European Union all have made it pretty clear that they don't want to renegotiate. Meanwhile, many companies here on the European continent, but also in the United Kingdom, are working on their contingency plans for a no-deal Brexit. Lidl, for example, which is a large German supermarket chain, a discount supermarket chain, which is also very active in the United Kingdom, it has advised its British suppliers that they will have to pay any EU import tariffs which might be imposed on goods crossing over into the United Kingdom after Brexit. So any cost related to that Lidl wants the British to pay.
And investors have been keen to get into safe haven investments. All of the German government bonds yields for all of the different maturities are in negative territory, same in Switzerland. So What is expected for this week?
Well, there is a little bit of the relief at the beginning of this trading week. Bond markets, you know, those super low yields in negative territory. As you said, for Germany, all of our government bonds are yielding negatively. The same with Switzerland. Denmark now, also a few of their government bonds are coming along with negative yields, which means that you actually have to pay if you buy those bonds every year. You lose a little bit of your money, but large investors are willing to go into those bonds because, as you said, they have a reputation of being super secure. Today, the music is a little bit on the equity market. The German DAX up 1.4%. We did get a bit of optimistic and encouraging factory order data. German goods, especially, you know, German engineering products, machinery, also consumer goods are in demand, and that's a bit of, you know, a relief given that we had all this talk about recession. Well, and today the Bundesbank, our reserve bank here in Frankfurt, says we're not out of the wood yet. Germany's economy might still fall in a recession in the current quarter.
And still on the outlook, Brexit events, G7 summit, and of course the meeting of reserve bankers in Jackson Hole, which is of course scheduled for the upcoming weekend. What's most important for the markets as it is?
I think that this Jackson Hole meeting is very important, given that it's not the only event where a central bank, the Federal Reserve, will you know, express itself. We're expecting the minutes of the last Fed meeting due to come out Wednesday night. Of course, this is a written, you know, a report of what the Federal Reserve bankers discussed at their last meeting. But of course, people will watch it very closely and search it and scrutinize it for hints what to expect in terms of an interest rate cut in the United States. You know, all different sorts of numbers are out. 2 cuts, maybe even 3 cuts, I don't know. We will find out, and we will find out more about what the Federal Reserve is thinking in terms of inflation outlook and in terms of economic outlook.
Exactly. Well, it looks like a jam-packed week for the business people there. Let's keep an eye on these developments, Brexit, G7, and of course the Reserve Bank meeting in Jackson Hole. Thank you for your time, Conrad. Enjoy the rest of the day. And stocks in Asia rose today as U.S. Treasury yields bounced higher after plunging last week. Shares in mainland China led gains in the region as they surged on the day, with the Shanghai Composite adding 2.1% to 2,883.10, and the Shenzhen Composite also advanced 3.048% to 1,571.97. On Saturday, the People's Bank of China said it will improve the mechanism used to establish the loan prime rate from this month, allowing it to use market-based reform methods to help lower real lending rates. And Hong Kong's Hang Seng Index also jumped 2.4% as life insurer AIA stocks surged 3.22%. In Japan, the Nikkei 225 rose 0.71% to close at 20,563.16. Meanwhile, South Korea's Kospi advanced 0.66% to close at 1,939.9, while the ASX 200 in Australia gained 0.97% to end its trading day at 6,467.40. And in the U.S., stock index futures pointed to a higher open today. At around 1:30 a.m. Eastern Time, Dow futures rose 146 points, indicating a positive open of more than 172.99 points. Futures on the S&P and Nasdaq were both also higher. Wall Street ended Friday's session on a more positive note on the back of a rebound in bond yields, which eased ongoing recession fears. Nonetheless, traders are keeping an eye on U.S.-China trade relations. In corporate news, Estée Lauder and Baidu are set to report earnings on Monday. Meanwhile, there are no major data releases scheduled. And away from the equities there, looking at the global oil market, OPEC delivered a downbeat oil market outlook for the rest of 2019 over the weekend as economic growth slows and highlighted challenges in 2020 as rivals pump more, building a case to keep up an OPEC-led pact to curb supply. In a monthly report, the Organization of the Petroleum Exporting Countries cut its forecast for global oil demand growth in 2019 by 40,000 barrels per day to 1.10 million barrels per day and indicated the market will be in slight surplus in 2020. The bearish outlook due to slowing economies amid the U.S.-China trade dispute and Brexit could press the case for OPEC and allies, including Russia, to maintain a policy of cutting output to support prices. Despite the OPEC-led cut, oil has tumbled from April's 2019 peak above $75, pressured by trade concerns and an economic slowdown. Meanwhile, crude oil prices rose today following a weekend attack on a Saudi oil facility by Yemen separatists and as traders looked for any signs that Sino-U.S. trade tensions could ease. But price gains were capped by an unusually downbeat OPEC report that stoked concerns about growth in oil demand. Brent crude was up 64 cents at $59.28 a barrel. U.S. crude was up 55 cents at $55.42 a barrel. Concerns about an economic recession continued to weigh on crude prices, even as Trump and top White House officials dismissed concerns that U.S. economic growth may be faltering. Away from the global oil market there, back here on the African continent, the Africa Development Bank says the U.S.-China trade war and uncertainty over Brexit pose risks to Africa's economic prospects that are increasing by the day. The trade dispute between the world's two largest economies has roiled global markets and unnerved investors as it stretches into its second year with no end in sight. Britain, meanwhile, appears to be on course to leave the European Union on October 31 without a transition deal, which economists fear could severely disrupt trade flows. AFDB President Akinwumi Adesina says the bank could review its economic growth projection for Africa of 4% in 2019 and 4.1% in 2020 if global external shocks accelerate. And the International Monetary Fund has warned the government of Zimbabwe against boosting wages for state workers after the introduction of a new currency pushed up inflation and reduced spending power to a tenth of what it was as recently as February. In the 6 years to 2016, Zimbabwe boosted pay for its about 400,000 civil servants to a level where their pay accounted for more than 90% of tax revenue, compared with 40% in 2010. This puts the IMF at odds with Finance Minister Mithuli Ncube, who said in an interview that he is in favor of boosting wages in both the public and private sectors to restore living standards and create consumer demand. Ncube has also said he expects the economy to contract this year for the first time since 2008. In February, the government said a quasi-currency known as bond notes and RTGS dollar in their electric form would no longer trade at parity with the US dollar, and in June it reintroduced the Zimbabwe dollar, which it had abolished in 2009 after a bout of hyperinflation.